So let me continue with dYdX because there's something else that they do that's really fascinating. And it's the idea of perpetual futures. So what is that? So let's kind of go through what this actually means. And the traditional futures contract has got an expiration. So you buy, it could be crude oil for delivery in September. And there's various different expirations. But with perpetual futures, there's no expiration to the contract. Effectively, it's rewritten every day. Okay, so, and with futures, you're just betting on the price going up or going down. That's it. So if you believe that the price is going to go up, then you go long. So you're buying, and usually you're buying in the future. So in my example, if you think the price of oil is going to go up, then you want to actually go buy a long contract for, let's say, September. And hopefully the price is well above that, and you get to buy cheap. And every day the contract is rewritten. If the price goes up, it's rewritten. And essentially this is a bet on price appreciation. And of course, the other side is the short futures, where if the price you believe is going to go down, then you sell. So again, this is a protocol that allows for a futures contract with no particular expiration. Okay, so this is also something that you could use with leverage or without leverage. It's completely your choice. So let's kind of go through what's actually happening here. For those of you that are experts on futures and forwards, this is just a swap. And it consists of a portfolio of one-day forwards or futures. Okay, so this is effectively what this is. It is intriguing that we don't have a fixed expiration. So there's another kind of interesting aspect here, and that is that if you've got a lot of expirations, then there might not be a lot of liquidity for certain expiration dates. So you can actually look at this even in centralized finance, where you could pull up, let's say, again, the crude oil futures, which go out many years. But many of the expirations, there's almost no trading. And that's a big market in the world today. So even a very large market like crude oil, there's issues with illiquidity amongst many, many contracts. So having just one contract, the perpetual futures, seems to get around that problem of illiquidity. Okay, so basically what the perpetual futures actually does, you've got an index price, and again, the index price is defined in terms of, let's say, an average amongst the major exchanges. So you need some sort of benchmark index price. Okay, so and think of this as the spot price. So in terms of the Bitcoin US dollar perpetual futures on dYdX, dYdX uses the MakerDAO Oracle. Okay, so this is a popular Oracle to actually use, and it essentially looks at a number of exchanges that are trusted. And in the previous course, we actually went through examples of exchanges that were not real exchanges, in that the trading volume didn't make any sense, and other aspects that we went through. So we use, in this particular Oracle, Binance, Bitfinex, Bitstamp, Bittrex, Coinbase Pro, Gemini, and Kraken. Okay, so these are well-known exchanges. And essentially what we get is a price, an average price for the index. Okay, and that's going to be used as an input. So let's kind of go through some of the mechanics of the perpetual futures. So we've got an investor. They have to deposit some collateral for this, and they need to decide whether to go long or short. The leverage that's allowed here, interestingly, is up to 25 times. That's huge. So again, if you're trading something like Bitcoin US dollar, Bitcoin's volatility is like 90% on an annualized basis. The S&P 500 is 15%. Gold is 15%. Okay, Ethereum is about the same, 90 to 100%. So anytime you add leverage, you increase the effective volatility. So for example, if you're running at 90, let's say Bitcoin, and then you do 50% leverage, then your effective volatility is double the 90, so 180%. And now we're talking 25 times. Okay, so the contract itself, it could trade as a premium or a discount to the index. So obviously, the index will be changing through time as the price of the underlying is changing through time. But there could be a difference between the actual contract price and the index price. And that's going to be an important issue in implementing the perpetual futures. So there is a funding rate. And the way this actually works is that one side is going to pay the other. And this depends upon both the index move and this premium in terms of the contract price and the index price. So if there's a premium, so it could be a premium or a discount. So if there's a premium, so the contract is trading higher than the index, then the funding rate is going to be positive. And anybody who's a buyer or who's long, betting on the price to go up, is going to pay the short. And the funding rate is purely a function of the size of the gap in that, like a premium. And on the other side, if the contract is trading below the index price, then there's a discount. And in that particular case, the shorts are going to pay the longs. So this is a mechanism that happens every day. And this is a way to keep the futures contract price as close as possible to the underlying index. So the funding rate effectively creates this incentive. And it takes, like, essentially, like, it's an incentive to take the opposing side. And if that premium gets too big, then some of the longs are going to be sellers. And when they're selling, that's going to drive the contract price closer to the index price. So it's unattractive that the long needs to pay the short. So they'll just get out of their position. And this basically drives the contract price very close to the index price. So, so this is, again, part of the dYdX protocol. And this is, again, completely open. And you can see how these things actually trade, the various different markets. And again, it's open to considerable leverage. So the funding rate is updated effectively in continuous time. But it's really only applied at the time the user opens, closes, or changes a position. And this is part of the mechanics of how this actually works. and we need to explore the mechanics in some detail. So I mentioned already that dYdX operates in layer 2. So, and this happened actually in August or April 20th of 2021. dYdX moved the perpetual futures to layer 2. I want to remind you that we'll go into much more detail on layer 2 and the mechanics of layer 2 in the next course on DeFi risks and opportunities. But it's effectively something that's off-chain but secure with effectively a multi-signature vault. And as I already mentioned, the advantage of this, no gas fee. Okay, so that's a big deal. So stuff is going on in the layer 2 actively, but there's no gas fees. And again, we've got a pretty extreme leverage. So margin, of course, we've got margins with perpetual futures. You need to put some collateral in. There's leverage that's allowed. But as with traditional futures, we've got initial margin and a maintenance margin. So, and that basically means that if the initial margin is 10%, there is another threshold that's a little lower. And if you hit that threshold, then you need to repost the margin right up to the 10%. Okay, so that's how it works. However, if you don't post, then you can be liquidated. Okay, so again, in traditional finance, you get a margin call about this. In decentralized finance is nothing like that. If you're not watching this carefully, a keeper's going to come in and liquidate your position. Okay, so again, given that we're going to talk about futures, and many have not had a course on futures or options, I just want to make sure that everybody is on board in terms of how this actually works. So in a traditional future, if you think the asset is going to go up in price, then you actually enter into a contract to buy that asset in the future at a price that you think in the future is going to be higher than that price. So effectively, you're kind of locking in a lower price if there's appreciation. And of course, if the price goes down, that's bad news for you. So you're going to be a loser on that. Okay, so this is, again, a way to speculate on the price of an asset without actually putting up the collateral, 100% collateral. Does that make sense? So let's say you think the price of Bitcoin is going to go up. Well, one possibility is that you just go buy a Bitcoin. And if it goes up, well, you make some money. If it goes down, you lose some money. Well, another possibility is to agree to buy Bitcoin in the futures market. And we do have futures markets in traditional finance for Bitcoin. So we've got Bitcoin is traded, Ethereum is traded in traditional centralized markets. So those with regular futures contracts with fixed expirations, and of course all of the costs that are associated with those centralized institutions. Okay, so the idea of the futures is, well, maybe I don't have the money to buy like a Bitcoin. I do have, let's say, 10% of the money. So what I could do is to buy on the futures and essentially pledge the 10% as the margin. If the price goes up, that's great. If the price goes down, I could be wiped out. Okay, so I want you to understand like how the traditional long futures work, and the short is kind of the same thing, that you think that the price of the asset is going to go down. So you see the price today, and then you agree to sell at at some point in the future at a price that you think is actually a very high price compared to where you think the asset's going. So again, as the market falls, anybody who's short is going to get a good deal if they're buying in traditional futures. So essentially, what you're doing is that you've agreed to sell in the future at a certain price. So if the price drops, you go buy at the cheap price, and then you can sell at the more expensive price, and that's how you make your profit. So again, the profit is going to be the difference between the contract price and the market price. So a very good idea that has a long history in traditional finance. And I will admit that trading costs for futures generally are very small compared to, let's say, trading costs in other things like bonds or equities. So futures are a traditional finance market that's got low trading costs, but we're going to move this now to decentralized finance. So what about the risks here? And it's kind of obvious that one source of risk is the other side. So somebody is agreeing to buy, somebody is agreeing to sell. And if you are margined, then if you've got extreme margin, then it's possible with a big price move that you can blow through your collateral. Okay, the position would be closed, but it might be closed at a loss. In traditional finance, you've got a clearinghouse that deals with situations like that and provides some insurance. In decentralized finance, there are also kind of reserve pools for extreme volatility, and we've talked about that in terms of our lending protocols, to have like a reserve pool or a global settlement in the context of Maker. But this is definitely a risk, and it's especially a risk if you've got a very high leverage, because with the higher the leverage, the price move becomes smaller and smaller that wipes out the collateral. Okay, so the more leverage, the higher the risk of actually going underwater with a futures situation. Okay, so the other thing that's important is that futures are not options. So with an option, for example, in my crude oil example, I've got a call option where, let's say, I agree to buy 100 barrels of oil at $70 a barrel in September. And if the price is 90 in September, then that's great news because I get to buy at 70 and I can just instantly sell at 90. Indeed, I could just sell the option just before and I don't need to do anything about delivery. I'm not interested in receiving 100 barrels of oil, of crude oil. So if the price isn't 90 but 60, then I don't exercise the option. So I walk away. So why would I, think about it, why would I exercise the option to buy 100 barrels at $70 and then dump the, sell the oil at 60? So I just let the option expire. It's out of the money. Okay, so with options, you've got upside, but your downside is limited. Okay, and that's why they're called options. But with futures, there's nothing like that. So for options, to get that just one-sided payoff, you actually pay a premium for it. Okay, so having the one side you actually pay for, whether it's a call option or a put option. But with futures, there's nothing like that. If the price goes up, if you're long, you make money. If the price goes down, you lose money. And if the price continues to go down, you might actually go through all of your collateral, and at that point, you're closed out. Okay, so the important thing here is futures are obligations. There's no optionality here. Okay, so given that these are obligations, we need some sort of mechanism to make sure that there isn't a big price move that basically you go through all the collateral and somebody's going to lose some money. So it's really important to actually enforce. So let's go back to our margins because it's going to be important in terms of how this works. We set a maintenance margin. Remember, there's an initial margin, maintenance margin. Let's say it's 5%. And if the price of the asset drops, if you're long, and you're actually paying out because it's actually dropping, and if we get close to that 5, if we hit the 5, then we need to repost margin to go back up to the initial margin, which is 10%. If you don't do that, the exchange is going to liquidate your position. So I'm talking about a traditional exchange. You get a margin call, and if you don't post additional collateral, then your position is closed out. And let's say it drops from 5% to 4%, you're closed out, but there's still some collateral left over. So you get that 4% collateral back. So again, the maintenance margin is going to be very important. And I want to draw the distinction between what happens on dYdX and a traditional exchange. So some of this you can probably guess what I'm about to say, but if you fall below that 5%, then there's going to be a keeper that comes in and closes your position out. Now, this is different than a traditional exchange. Remember I said that, well, suppose it's 5%, you go to 4%, you're closed out, and then you would get the 4% back. Not here. So the keeper gets to keep what's left over as reward. So again, a strong incentive to watch that maintenance margin. Liquidation is effectively instantaneous. So this happens really quickly. Of course, there's no centralized exchange. There's no clearinghouse. Okay, so this happens, again, very quickly. There's no trading hours. And these are contracts that are perpetual. So it's not the third Friday of the month where there's settlement of the actual futures. Futures settle every day, but there's an expiration date in traditional finance. So these have no maturity dates. So very interesting concept and very important innovation in DeFi.